let's take a look on the opposite side. Okay. The opposite side is your bearish signals, what I call violations, right? Bullish signals are confirmations, right? The breakout's being confirmed. Bearish signals are violations. Now we're going to go through these. I'm going to show you some charts, just like we showed just before. But I want to go through the list here. So low volume out, high volume in is the first one. All right. This is when you break out. Now you could break out on high volume, but if the volume comes right back in, the stock comes back in very quickly on higher volume, that's a red flag, right? That may not be a reason to sell, but it certainly should get your antennas up. Then you want to look to see if you've got a number of consecutive lower lows, not closes, lower lows. So 3 lower lows should get your attention. A 4th lower low should really get your attention. Now, especially if they're on volume, if they're on very low volume, it's pulling back pretty naturally. It could be okay. But as you're making the lower lows, especially if they're on volume, you want to start looking for supportive action around the 3rd or 4th lower low. The reason is because institutions, this is all about understanding the footprints and the buying patterns of institutions. Institutions will they'll buy a stock. And Dave, I'm going to want you to talk about this. So they'll buy a stock, and because they've got such big volume to move, they'll run the stock up. And there might be a number of institutions in there, but even one institution can run a stock up. So as they start running up, they back off. They don't want to defeat their purpose, right? So they back off. Now, as the stock comes back, usually a couple days, 1, 2, 3 days, they go back in there and they start buying again, because they told their trade desk, they told their traders, we need to get a 1 million share position in this, get us in at a 45-degree angle here. And so on the pullbacks, they don't want the stock to get away from them. They want a position. So every little pullback, they go back in there and add to it. And that's what creates this pattern. Right, Dave?
Yeah. Yeah. It's because, think about it. It's, as Mark said, institutions aren't buying 1,000 shares and then they're happy they've got their position. They're buying millions of shares, and it takes more than a couple of days, especially in some medium-sized cap companies. It takes them 3 weeks to get their position, and that's where you see the big buying show up. But if it does get extended, they'll back off. They'll wait till it comes back in again a little bit, and then they'll keep on buying until they finish their position. But it takes a lot more time, and that's what you're looking for. You're looking for their footprints in the market as a stock's moving out.
Right, and if that stock's coming in, and it's coming in for day after day after day, and big volume on the downside, well, then that's telling you that there's not a lot of institutional support there, and it might have been retail buying, and now you may even have institutional selling if the volume's picking up. So after 3 or 4 days, we're going to show you examples of this in just a second. I know right now you're having to use your imagination a bit. So more down days than up days, just the reverse of what we talked about before. More bad closes than good closes, just the reverse, right? Now, the other thing is I don't use moving averages almost ever for a crossover. There's only a couple instances, which you're going to learn about all those today or through this workshop. One is, though, immediately after the breakout. Again, once the stock's up and it takes off, it's not as important. But right after the breakout, the 20-day line becomes important, and the 50-day becomes even more important. And what we found was when a stock breaks out of a base, if it comes and it comes back in and it closes below the 20-day, the probability of it working cuts in half. It's half the probability. If it had a 50% probability, it's got a 25% probability now. And if it goes below the 50, the probability goes down even more. So we want to see it hold those two lines. Sometimes the 50-day will be lower than even your stop will be, and you don't have to worry about that. But certainly if it goes below those and it closes below them, it's another red flag. Now, wide and volatile price action. All right, that's another thing we're going to show you in just a second. But now the key is that it's not like one of these is going to say, hey, we're going to sell the stock. No, you're just going to start watching and seeing if the violations are piling up. You start getting 2, 3 violations all piling up around the same time, then yes, you probably want to start reducing, or if they're really critical, really serious violations, you'll even sell the stock. Let me show you what these look like now, okay? Let's start off with low volume out, high volume in. Low volume breakout, high volume back in, and a close below the 20 and 50 day. So this was a late stage base in lumber liquidators. Lumber liquidators was holding up really well when the market corrected. It took off. It made a really big move, and then it came off of this, which amateurs would see this and probably buy this as a base, maybe a cup with a handle here. Look at it and call it a VCP. It's pretty sloppy, and it's not the greatest pattern or greatest price action, but it does break out of here. But then what the key is, you see it comes out, and the volume's not even that great to begin with. But then just a couple days later, see, there's no follow through. The next day it's down, then it's down again. Then it gets this little feeble 2-day rally, and then wham, gets crushed. And look at the volume, and it gets below both the 20 and the 50 day. So if you hadn't hit your stop yet, let's just say your stop was at 8%, and this is down 6% here. I'd be out. I'd definitely get out of here. This is totally abnormal. This is not how a stock should look after it breaks out. Let's show another example.
Yeah, I was going to add, and then you can see it. The same thing on this it's the 1 day breakouts. I hate the 1 day breakouts. I mean, if it only goes up 1 day and then it starts reversing, that's a major flag, because what that is just a lot of retail buyers seeing a stock. It's been consolidating. It's got a decent base. It breaks out. And in fact, that it only goes 1 day is just telling you it's probably just retail buying. There were no institutions adding on or buying new positions, and it starts reversing, and that's a telltale sign right there.
Yeah, and it doesn't mean you don't necessarily sell. You see 1 day breakout, next day it's down. That's not a sell signal, but it certainly is it should raise your antennas, and you should start watching it carefully, because it needs to put on its running shoes pretty quickly. You want to see it get right back into new high ground and see that if the volume didn't come in on the breakout, or you didn't get the follow through days, you want to see them in subsequent days in not too long. You're trying to get your timing perfect here, and within a number of days. So if this stock doesn't get going, within a week or two, you probably mistimed it pretty severely. So let's take a look at another one here. Here's it's simple as OUTR. This is an older company, Outer Wall. Not even sure if this is listed still. You get a nice little gap here, drifts back here. Okay, breakout right here, right? So this gets a 1 day, 2 days. It actually moves up the next day, but has not a great close. But then you see it comes right in, and then the volume comes in on that next day. You see the volume is much higher, much higher. Now, again, we're going to start looking and counting. This is 2 lower lows. So we didn't get the 3 lower lows yet, but now we're sitting there right by that. I believe this is the 50 day, right? Yeah, this is the 50 day. We're sitting right at the 50 day line. 2 days later, boom, we're below the 50 day line now. So this is really just showing very abnormal action. I would have been out of this right away, probably right on this day right here anyway. I want to point out too, again, I said this before, but I want to say it again, that most of the stocks that we're showing you, not all of them, but most of them, the grand majority of them, I was trading at these times, that I was buying these breakouts. And I didn't have hindsight. There was no hindsight. These aren't where we went and picked charts that made our point. We said, oh yeah, this one looks good. Yeah, some of them we've studied some leaders and studied some stocks and pulled out some models, but the grand majority of these, 95% of them, are stocks that I've actually traded.
Yeah, Mark, one thing I just wanted to point out on this chart too is when that stock gapped from 64 to 72, you have to ask the question, even there, why didn't it follow through? Because if it's such a great stock and it must have been some earnings news or something to get it going, why didn't it keep continuing, or even after 3 or 4 days take off and go? But it sat there for, it looks like 3 or 4 weeks and tried to move. So interesting sign that you might have seen could possibly fail if it didn't follow through the first time.
Right. And this right here, what David's saying is that as you drift back here, and we talked about, coming back for a number of days and then erasing it very quickly, this looks okay. This looks, pretty good. It's coming back pretty quickly, and, it didn't follow through here, but it drifted back, and now you're saying, okay, tennis ball action here looks good, but now it doesn't confirm. It doesn't confirm. And David's saying over here too, this just wasn't, you'll see some of these stocks, they'll break out on earnings and just keep running and running. And that's where we see something like the MVP move where you get the 12 out of 15 days. And now, yes, it may be extended and you're not going to buy it there, but it showed that previous power. It's showing that there's a big appetite for it. What David's saying here is there's no real appetite for this stock. And then even here, when we thought there was some appetite, nope, it came right in. Let's look at some more. Okay, so here's another one where we get the breakout here. And then you see it doesn't follow through much. And it just immediately stalls out. Now you get 3 lower lows, 1, 2, 3. At that point, I want to see some support. I don't like that it closed right near the low, this big down day, and it closed below the 20-day line. So now we've got some violations here. We didn't get any follow through, right? We didn't get follow through buying. We've got 3 lower lows. We got bad closes. Every close is bad. It's below the 20-day line. This is really looking ominous at this point. And then look at the next day, wham, right? Now it just comes in, it's right off. You can tell how, it just didn't act right. And right there, it's telling you either reduce or run for the hills. All right, another one, all right, TRTN. Really nice little pivot here. And again, sometimes these are going to look beautiful. Just because you get it down and you can spot a VCP and you get this great pivot point and it's got all the characteristics, it doesn't mean it's necessarily going to work. And Dave, we should talk about how, let me ask you a question, Dave. In all your years, you've been doing this longer than me. I don't know how many years now you've been doing it, but certainly over 40. What percentage of stocks are your gainers versus your losers? How often are you actually right?
Well, if I'm right half the time, I think I'm doing a great job. Because I play a lot of stocks, I invest in a lot of stocks, but if it's half of these don't work out, I take very, very small losses. But if I can have 2 or 3 really just take off and go and have a huge move, and I buy them correctly and I add to them correctly, those 2 or 3 big winners makes up for all the very, very small losses.
Yeah, and sometimes the stock looks perfect, but you know what? The market's just bad. And you actually get the analysis right, but the market is just in a tough time, might be going into a correction, and stocks are even giving you heads up that you're heading into a correction. The market really looks fine if you're looking at the Dow and you're looking at the S&P and the NASDAQ, but the stocks aren't acting right. And then later on, the market rolls over and the stocks were sort of the canary in the coal mine. So here, again, I want to show you some examples where where you can get lured in, where it looks good, but very quickly it doesn't look good. And I always say, always be prepared for the opposite side of the trade. So when you are long, you need to be prepared to move very quickly and move to cash. When you're in cash, you need to be prepared to move very quickly to getting some exposure on, because things change very fast in the market. You can go from 1 minute there's no stocks to buy, and then there's a whole ton of them. In 1 minute everything's acting great and you're all happy and giddy and making tons of money, and the next thing, whammo, you're giving half of it back and you're underwater before you even realize it. So again, here we break out, right? You get a little follow through day here, right? You get another day, but then look, the big volume comes in. Look at this big bar. So you've got the volatility, much bigger bar to the downside, right? And now you've retraced, a full retracement of that move, high volume in. So you got low volume out, high volume in, and low volume out, high volume in doesn't mean that it's a low volume breakout. It means that the volume on the downside is larger than the breakout volume. And now you're getting some lower lows. You get 1, 2, 4 lower lows. So you're getting below the moving averages now. You're below the 20 and the 50. If you had not hit your stop yet, I would be out of this regardless. My stop was maybe a little lower than this, I would still be out. I wouldn't even wait for my stop at this point. And you see here, then it just goes stone cold dead, can't rally. And then the real selling starts coming in because it's under distribution. Institutions are selling. And now you really start to get the damage. Let me show you another one. So here you go again, where you break out. This was OLED. Come out of this little base here. Nice little pivot, squat, reversal recovery, little pullback, back into new high ground. This is looking not too bad. Okay, we got out of the gate and we're holding up pretty good. 1, 2, 3, 4, 5, maybe 6 out of 8 days or so up. Not too bad, looking pretty good. But then we get 1, 2, 3, third day down, pulling back to the breakout. Fourth day, now we're below the 20, the 50, full retracement, high volume in. No, this is we're getting violations now. Now you got to start reducing. You got to start looking, or at least have your heads up to get ready to sell as soon as it hits your stop. Another one here. Now, here we break out of this base, which already wasn't a very good base. It's kind of sloppy to begin with. But we come out here and we get a decent breakout, big breakout here, a couple small follow-through days. Now, this pullback right here, this is not something that's abnormal yet. Even with the 4 lower lows, this is okay because it's quiet. You're pulling back naturally to the breakout point. And if this turned up and came back into new high ground, that would be great. I would deem that as a natural reaction. But look what happens. It tries to turn up, and then boom, it comes in. High volume in. See, it's a failed natural reaction. And it closes now below the 20-day, and it can't rally. See how it just wedges itself up? And now the selling starts coming in. This little circle right here is where you definitely want to be out. If you weren't out here, this is a 100% you get out at, regardless of where your stop is. A little dead cat bounce here, and look, now the big selling comes in. Now you get the real damage comes in. That's what you're trying to avoid. When you start getting these violations, it could mean that you've got some real distribution coming, and the heavy selling hasn't even started yet.
Yeah, the thing to point out, I think that, and you mentioned it, is on that high volume day down. It was down that day, and then 3 total days in a row were down. But then it looks like it looks like about 12 to 15 days where it couldn't even retrace what it lost in 3 days. It tried for 15 days to get going, and the fact that it couldn't retrace that was telling you that this thing had no power at all, and was something that was probably ready to really roll over.
And Dave, if we flip this over, we would get exactly what we were talking about on the upside, on the downside, right? We got where here you pull back all these days, right? Yeah. Or you rally, if you want to call it. You rally all these days, and then just in a couple days, boom, you're in new lows. Yep. So exactly on the opposite, where we look for the pullbacks, they come for maybe a couple weeks, and then just in a few days it erases it all. This is the same thing, only in reverse on the downside. Most of what we show you is going to just be the opposite on the upside to the downside. These rules. That's what makes them really easy to follow. Is that once you get good at them, you just look at them from either side. So here's another breakout. This was in Michael Kors. Came out of this little pivot right here, this cheat area, and immediately had trouble. It tried to tighten up and what I call a reset, and tried to turn up again, and immediately failed there. And this is where I really said, oh boy, this could be getting into big trouble here, because this is just totally abnormal now. It tried to come out here, and then it tightened up a bit more and had another failure. Now this is what I call a ledge, where you just go straight sideways. After you break down, you go straight sideways and you can't rally. And just like we just showed you before, you see how it takes a number of days, I don't know, 5, 10, maybe 15 days to barely rally back at all, just like Dave said. And then just in a couple days, boom, it's right into new lows again. We actually put this on our short list right here. This was one of our recommendations on the short list as it broke through the 200-day here and was breaking down from this ledge. So it went from a potential buy over here with just not long later, within a number of weeks, we're looking at shorting this, and this stock imploded from there. It had a big decline from there. I'll show you another one here. So again, you see you break out here. Here's the pivot point. You get the 1, 2. Okay, great. Everything's okay at this point, right? All right, now you get a couple reversals, and you're not getting much follow through day. If you count the days, you got 1, 2 days up, 2 down, 3 down. So if you got down days outweighing up days, you get a little feeble rally, and now you get 3 lower lows below the 20, below the 50. See, everything's piling up on you, right? All these violations are piling up. That's where the red flag starts coming up, when you start seeing a number of violations. And again, your stop might have already been hit at this point, but in this case, probably not, because this is just coming right near the break-even point. So this really probably wasn't at a very big loss. Then you put in the ledge, so you can't rally much, and then back into new lows. Let me see if we have any other examples here. Yeah, well, this one right here, you get a gap on earnings. Then you get a nice little pivot right here. It breaks out, but then you get 8 lower lows here, right? This just, and it retraces everything, comes all the way back down here. And now again, just like before, you see it takes a number of days, and just in 2 days, boom, exact opposite of what we want to see on the upside. Now, another thing is, looking whenever you buy a stock in a base, you always want to look to the left. The left is where it's like looking for traffic crossing a street, but think of it on a street that's one way, right? Everything's coming from the left. You're on a one-way street, because that's where your supply is. And being able to be cognizant of what type of supply is to the left of you, it really will keep you out of a lot of trouble, or keep you away from troubled situations. Because again, Dave, you always say, just draw a line across where the majority of the price action is. This is a perfect example where this stock, really, it's just constantly had trouble. It tried to break out here, had trouble, came back up, and just keep trying to base here. But this level right here really becomes a formidable opponent, right? And you just can't get through it. So when I see that, what I want to see happen is I want to see the stock get near that level, tighten up, and quiet down, because that means this supply on the left side has stopped coming to market. Yeah. Remember, we talked about the towel getting squeezed and the water coming out of it. That hasn't happened yet. There's still a lot of water in this towel, and that's why it can't rally, because there's a lot of selling. There's a lot of supply. There's a lot of stock for sale, and it does just the opposite. It breaks down, and it forms this little pivot to the downside. It forms a little mini ledge, and then breaks down again. So again, looking to the left and looking for price action to the left.
Yeah, it reversed. You can see 1, 2, 3, almost 4 reversals right there in that 48 to 50 zone, and it reversed, and it closed on the low almost every single time. Yep. I've actually I came up with another term the other day. I think it might stick. It looks like a porcupine. It's got these quills that are sticking up. Yeah, and boy, you can get stung, or you can get hurt badly if those quills go into you. And this is exactly what happened.
Porcupine supply.
It's a porcupine pattern.
Yeah. There's, and again, you'll notice that each time I show, one of these charts, that Dave will come up and come up with this nuance. I'll come up with a nuance, and I'll say, okay, take a look at this, and I'll go deep into the pattern, start looking at specific days, and then Dave will go in even deeper and find these little nuances. See, this is the type of eye that you're gonna develop over time, but you've got to do this in real time. We're doing it, and we're showing you here on charts in hindsight, but you've got to learn to do this in real time. We do this in real time because we've been doing it for so many years. You'll get there too, but it's going to take some time. That's why you have to do post-analysis and go back and look at your trades and see if you're seeing this stuff. If in real time you're making these plays correctly, and then you'll see what you did wrong, what you did right, and you'll start to see those common denominators. So like I said, always be prepared for the opposite side of the trade. This is why. You see this stock breaks out here, you get the natural reaction, and then it fails. And you get the 3 lower lows, the stock can't rally, and this stock ended up going down 99% in just 3 months. That's the risk that's in the market. Look at the huge volume that comes back in here, right? That's where, not necessarily you can call it a low volume out, high volume in. It does come after the natural reaction, but this is a complete tennis ball action failure. It tries to break back up, and then just comes right back in, and you start getting the violations. You get the big volume in, you get the 3 lower lows, you get the close below the 20, now the 50-day. Like, you can't rally. If you did not hit your stop yet, you would want to be reducing this or even selling this even before.
Yeah, and then the other thing too is look at the 2 days that stock moved out from. I guess it went through 19 and 20. Farther. Yeah, right there is look at the closes on those 2 days when it should be breaking out and closing near the high or the upper half of the range of those days. those look like 2 stalling days. Yes, they were up, but they traded higher and closed in the lower half of the pattern, and just kind of telling you that didn't have enough fuel, enough power to get it going.
Yeah, you're not really getting that real strong tennis ball bounce.
Right.
So what do all these examples now have in common? What are all these failures? The breakouts that were successful and had the confirmations, every one of them had certain things that were all in common. All these failures have certain things that are all in common too. One is lack of follow-through. More down days than bad days, and more bad closes than good closes. Up days. Very poor volume dynamics, where you've got on the upside, instead of having the strong volume on the upside, you've got the weaker volume on the upside and the stronger volume on the downside. Reversals, where or what Dave just called the porcupine look, where we have all those reversals in that supply, and then closes below the 20, the 50-day line soon after the breakout, and no tennis ball action or very weak tennis ball action. In some of these cases, we saw just the opposite. The tennis ball action, if you will, it was like we flipped the chart upside down, and it was having tennis ball action, but it was to the downside, right? So again, just looking for these violations and these confirmations are going to start to have you understand when a stock is acting normal, when it's not, when it's under accumulation, and when it's under distribution, and when there's institutional money in there versus retail, or maybe to be able to spot the retail breakouts and the institutional selling into those breakouts.